Hello everyone and welcome to your Glassnode video report for week 48. I'm your host Checkmate. We're recording this on the 30th of November 2021. Now this week we have really assessed the drawdown that we've seen in prices and quite interestingly look at some of the strength that we're seeing underlying this correction. And what we'll do is run through a number of comparisons between where we currently are in the market cycle and comparing it in particular to the dip that we saw in September. Because even just from a visual perspective looking at the price chart, there are similarities between these. So really what we want to look at is what do we see on chain? What's the comparison between these two cycle corrections? And really what can we see between the short and long-term holders? Now, what we'll start with is an assessment of this drawdown and just look at the different magnitude because you may be surprised, but this is actually the least severe correction. You can see on the chart on the top right here, it's only minus 21.8%, which for Bitcoin, most traditional markets will call that a bear market. In Bitcoin, that's almost just another day in the office. And it's actually one of the least severe drawdowns that we've seen in 2021. So it kind of puts things in a perspective, and we're going to go into it with that framework. Now, we're also going to look at the leverage in the system. So in particular, we've got a relatively elevated open interest across both options and futures markets. We'll look at a little bit about the CME or contract, because obviously that's now part of the ETF, the backing instrument behind those. So we'll look at how those different dynamics are in play, and then we'll dive into our supply dynamics and short and long-term holder assessment. So let's jump into our week on chain dashboard and get started. So as noted, we're still in this correction that we've had for almost half of November, and we traded down from about 59,000 to a low of about 53,000. So it really did get that pullback, and it is coming off these all-time highs, and sentiment is obviously reacting to these downwards prices. It's quite interesting how things can shift from a $69,000 all-time high towards relatively bearish sentiment across the market as things start to pull back. Now, what we have at the in this chart here in our price drawdown from all-time high, this is a useful metric we can use to really assess kind of the severity of these different pullbacks. Now, obviously, these red bars show how far below the all-time high the current price is. Now, naturally, here is in 2020, so we have quite a large block. This is when we were trading below the $20,000 all-time high. We traded up and finally broke above it in December. Now, what we've then seen is that in January, we had a fairly substantial correction down here, 27%, 27.4%. We had another one here in February, which came down to around 22.6%. So you can see that these are non-trivial, right? 20% is normally what's considered a bear market in traditional assets. So to see a correction of 22%, 24%, and that essentially be just a standard correction within a Bitcoin bull market kind of goes to show just how this asset trades with a much higher degree of volatility to what many money managers are typically used to. Now, we obviously had a fairly severe drawdown. So it started in April where we had another correction of about 24.2%. And then we had a fairly substantial, I've been calling this a miniature bear market because many of the activity metrics, we talked about this in previous video sessions, where we look at the real drawdown in the amount of on-chain activity. We saw active addresses fall, transaction counts fall, volumes start to fall. But then what we really saw is those volumes were picking up despite those activity metrics falling down. And that's generally a sign that some of those bigger money players are starting to move around in the space, and the supply dynamics were hinting that a supply squeeze could have been in play. So we obviously saw this fairly substantial correction. This was down at minus 54% at the worst case scenario. Now, interestingly, in the September's correction, if we look at it, because remember that this is tracking from the all-time high. So this is actually mapping back to the $64,000 all-time high back here in April. So on that correction basis, we're at 35.8% back here in September at the lows. But even if you measure it from just the local top up here at 53,000, the pullback was still about 25%. So that's still more than where we currently are off our new $69,000 all-time high. We're currently at about 21.7% as a drawdown, which amazingly, whilst it may not feel like it, is actually one of the least severe across all of 2021. So just quite an interesting perspective when you put the entire market cycle into context. We're actually sitting at the least severe correction, despite the fact that it may not feel like it following much of the sentiment on social media and the like. So now we're going to look at the derivatives market, because quite often when we see corrections, this is a key area of focus. When there's too much leverage in the system, it just creates a potential for a squeeze. Now, remember that a leverage squeeze is essentially a forced liquidation. You've got traders who are either short or long, because a squeeze can happen in both directions. There's too many traders with too much on the line on leveraged positions, and when the market moves against them, they're forced to close their positions. Now, if you're net short, that means you have to buy back your position. If you're net long, you have to sell your position. So it essentially creates this cascade where somebody's stop loss pushes price further in one direction, and that then triggers somebody else's stop loss and somebody else's liquidation, and you get this cascading effect. Now, it's not a direct science. There's no specific level of leverage that is too much. We have to look at a number of metrics in context to just understand what the probabilities are. We're looking for what could be the trigger points and what does that generally look like on an overall basis. Now, what we have here is our futures open interest. Now, I've denominated this in BTC terms. This is not in USD terms, and you can see that it trades quite differently. You may be used to the generally following the price chart, and that's because when you have things like coin margin futures, when people's position size is denominated, say they've bought 0.1 BTC, that's their position size, that's going to obviously change. The amount of leverage will change, or open interest will change with the coin price. Now, conversely, if we actually map this on in terms of BTC value, we're essentially removing the influence of coin price when we're assessing open interest. It's just another way to look at things. And what I'm really looking for when I'm assessing open interest, because there's no exact level that's too high. It's all relative to how large the market cap is. The larger that Bitcoin is, the higher the amount of leverage it can likely absorb, because there's more trading volume, more interest. But what I'm really looking for is rapid changes. Now, what we have at the moment is we have seen a fairly substantial growth in open interest. Let's actually zoom in to 2021. We've seen a fairly substantial growth in open interest in BTC denomination over the last, or essentially since the September lows. Now, note how this has actually been sustained. We are pretty much at all-time highs when it comes to BTC denominated open interest. So there are a lot of contracts that are currently open up here in this level. So we know that there's quite a bit of leverage that's baked into the system, but note where this started. This was in the September low. We saw this fairly large expansion. Now, this on the right here is the futures open interest, but for the CME contract. Now, what's quite interesting about this is essentially being driven. You can see another very significant growth in open interest that has occurred from the low in September. So obviously we're seeing some kind of growth combination, right? Some of this open interest is coming from CME, and the reason it's coming from CME is obviously the introduction of the ETF product. So now that there's billions of dollars that's flowing into this ETF product, there is more open interest being opened up on the CME exchange. Now, quite interestingly, the dominance of the CME contracts, when we look at how much of this total open interest is actually a result of the CME, it has grown from this point in September from 10% to about 19.5%. So it's almost doubled. So the amount of open interest that is on the CME, largely driven by the ETF, has essentially doubled since its launch. So it does show that there's been a growth of overall interest in that product. It shows that the CME, which is a large regulated US exchange, is picking up more of this volume as well. The volume is up from about 1.4% of total trade volume to 6%. So it's all part of this maturation of Bitcoin as an asset, of the market structure as a, overall we're seeing more of these institutions stepping in, more larger traders, investment banks. We're seeing more of this institutionalization of Bitcoin as an asset, and this is really reflecting that. So in part, yes, it is certainly something to be concerned, or at least aware about. Concern is probably the wrong word, just aware that there is elevated leverage. Now, what I find quite interesting is we've seen a price pullback, and we haven't really seen what I would call a leverage flush. We saw here a short squeeze where we get these big dramatic drops in open interest. We saw the same in May, very large drops. Now, it can be a long squeeze or a short squeeze, but what we're seeing there is lots of traders on the wrong side of the boat getting tipped out of their positions. Now, we haven't seen that despite price correcting 21.5%. Our options open interest is also relatively elevated, although cooling off a little bit, but still trading up around all-time highs. So the question is, how can we have this correction that's quite significant, right, on a relative basis? It is a non-trivial correction, but we're not seeing a leverage flush out. So then we can turn to something like our funding rate. And this is actually quite an interesting observation. Now, normally when you have some kind of a leverage cascade, let's actually look at this point here in early September, we saw this initial big drop in overall open interest, right? So this was actually a flush out. Now note how our funding rate accelerated more positive, more people were going long into that peak, and then we got the flush out. Right, we went through a period of relatively bearish trend, funding rate even went negative, and then we started to climb again. Now you can argue that we had another little bit of a flush out up the top here, but since then it's more or less traded sideways. And look what's happening to funding rate. It's actually starting to decline. So what we're seeing there is reducing funding rate as price corrects, but we're not seeing a long liquidation squeeze, right? We're not seeing all of these longs get flushed out of their position. To me, this is actually saying the market may be a little bit more sensible with their leverage, and potentially we may even have more short stepping in than people understand. So it's very possible that this open interest up here, it actually has a potential to squeeze in either direction. I believe that there could very well be some shorts that are stepping in this market, and their cost basis or where they've entered their position is somewhere within this correction. And it's actually possible that this squeeze, if it does happen, could actually occur in either direction. And sometimes we can actually see it go in both directions where it clears out traders on both sides. So overall, the leverage in the system is high. It's something to pay attention to. A great deal of it is actually coming from the CME exchange as a result of the ETF, so we have to factor that in. But simultaneously, we're seeing this kind of declining in positive funding rate, which is overall net positive for the downside flush risk, but it actually may hint that there could be an upside squeeze risk as well. So it's just something to just be aware of in this dynamic market. And I think it goes to show that this market could move in either direction, and you have to look at many of these variables in context to understand what's going on. So now we're going to move into the Onchain space, and we're looking particularly at spending patterns, and I'm particularly focused on the short-term and the long-term holder balance because they're generally our two cohorts. Over the last couple of sessions, we've really focused in on the short-term holders. We noted last week that they were kind of swing trading. We're seeing some of those dynamics in play. And we also mentioned their on-chain cost basis, which is around 53,000. That was a fairly key level to be paying attention to. Now, the market obviously pulled back to about 53,500. So it actually front ran that short-term holder level by about $500. So perhaps that's actually showing a sign of strength. We can also see here in our realized profit and realized loss metrics, realized profit continues to decline and hold these lower levels. My interpretation of that are that people who have profitable coins are spending less of them. So it's showing that there's more conviction entering. Fewer people are willing to sell their profitable coins here at 55, 56, 53,000 than they were up at the top here. So it does make sense. You get profit taking as price rallies and conviction grows. Fewer people are cashing out as price corrects. They're generally speaking waiting for higher prices, potentially even adding to their positions. Now, on the realized loss front, we saw a fairly substantial peak, right? It was up here about 750 or $770 million in a particular day. And you can see this is coincident with some of these larger flushes. So it's a non-trivial amount of losses being realized, and these are essentially top buyers. Now, generally speaking, some losses need to be realized during these corrections to flush out and exhaust the sellers. So until all of those sellers have been exhausted, generally price can't continue to move higher. We're also seeing a bit of a correction on that front as well. So fewer people are realizing losses now, potentially signaling that there's actually reasonable odds that this could very well be a non-trivial bounce. Obviously, the risk remains. We talked about leverage as a flushing potential as well. But it does kind of look like most of the spending that was going to happen during this correction may well have already happened. We can see on our short-term holder MVRV, so this is basically the distance away from their cost basis. We had this very, very nice little touch here of 1, or just above 1. This is a beautiful retest that we saw back here in September as well, and we saw it back here in October 2020. And if we look back to the 2017 rally, we saw very much the same thing, right? It provided support the entire way up. So seeing this retest of short-term holder conviction, also on the short-term holder profit loss ratio. So this maps out the ratio of short-term holder coins that are in profit versus in loss. And again, when we get these kind of retests or slight undercuts of this level of 1, it's showing that short-term holders are being tested. Their cost basis is being tested by the price. Their conviction is there. And the question is, are they going to step in and bid this thing to push it higher? or is it going to fall below their cost basis, which is at 53,000, and generate additional sell side? So that's certainly a key level to be watching, is 53,000, because if we do fall below it, short-term holders are going to be increasingly at a loss, and that's obviously going to create the potential for additional sell side. Now, on the SOPR and short-term holder, long-term holder supply metrics, we're starting to get into a bit more of the supply dynamics. So the SOPR metrics are showing their spending behavior, and the overall supply is then more in the supply dynamics. What is the unspent supply? So we can see that the short-term holder SOPR has been trading below a value of 1 for a little while now, which is not too dissimilar to September. This means that overall short-term holders are realizing losses. It shows that, and you can see it's not quite as severe as we had in May through to July, but it is very similar to what we had here in September. It's very similar to some of these pre-bull type pullbacks. So we need some of these folks to actually be buying the top and then selling the bottom. This is very typical market behavior. And again, it's exhausting those sellers. People who are realizing losses are generally selling to stronger hands, who are willing to step in and buy that dip because of information asymmetry or edge or whatever else it is. And we're essentially seeing that flush out, or that exhausting of all the sellers who essentially bought the top. We're starting to get that breakup back above 1. What we really want to see is that SOPR metrics start to climb alongside price, and much the same as what we saw here through August and then again in October. When we have elevated SOPR alongside price rising, it's showing that the market can absorb the sell side. People are cashing out profits and the market can continue to rally through it, telling us something about demand. Now, on the supply front, note that our long-term holders, we've seen about 5.8%. When we look at the total accumulation that they've done since March, they've sold about 5.8%. And you can see that this is reflected then in the short-term holder supply climbing. Now, if we look at long-term holder supply in total, you can see that we're talking about 13.5 million coins. This is only about 1% of their holdings. So overall, it's not a huge amount of spent behavior. What we're not seeing is a mass exit, right? If you were to see a loss of confidence, you would actually see a lot of these coins start to flush out. Long-term holder supply would decline at a much, much more rapid rate. And obviously when long-term holders spend their coins, they become short-term holder coins, right? They get revalued or reclassified, they change hands, and then we have to reassess whether they're going to be long-term or short-term. And what we can also see is a bit more volatility in the long-term holder SOPR. Now, where short-term holder SOPR is between 1.2 and 0.9, that's saying up to 20% profit, 10% loss is typical spending. Long-term holder SOPR typically has much, much larger profit multiples. The longer that people are holding their coins, they can realize 200, 400, 600% profits. Now, note that we've seen volatility. This is fairly quiet and trending. Right. So when we're talking about long-term holder SOPR, this quiet and trending is kind of orderly, relatively long-term holders are not spooked by the market. It's kind of orderly profit taking, cashing out. When we see a lot more volatility, what it's showing is that there's more long-term holders. Some people are selling for 600% profits. Some people are selling for 200%. Some people are selling for barely a profit at all. So the lower that this ratio is, and note how we've actually pulled back to 1.3, that's only a 30% profit. That means that long-term holders who purchased back here in the early phase of this bull are only getting 30% profit, despite the fact that some of these guys were getting 600 to 800%. So what that's showing is that there's a little bit of panic in there. Some of these long-term holders are in fact selling out for relatively small profit multiples. So prices, as it comes down closer to their cost basis, it may indicate, this volatility may indicate that there is some uncertainty. There is some profit taking. There could also be, just as we come into year's end, some tax harvesting or various other institutions closing out positions. So generally what we're seeing is this volatility shows that there's uncertainty. It shows that the prices where these long-term holder coins are coming from, where their original cost basis is, are fairly volatile. We're seeing that change a lot, and that tells us something about their overall sentiment. But on a macro scale, that's kind of on a spending behavior basis. On a macro scale, long-term holders have distributed about 5.8% of the total coins they accumulated over the last 6 or 7 months. So on a total relative basis, it's a relatively small and orderly distribution. It doesn't look like a mass exit. If we were to see this turn around, then perhaps we would have to change that overall perspective. Now, the other thing that I want to really highlight looking at these particular charts. So this is looking at the total supply by short-term holders and long-term holders, that's in profit. Now, I mapped it out in the newsletter itself, where we actually look at these area charts, and you can see here we have our long-term holders in profit, short-term holders in profit in the dark colors, and then the light colors are the same but for coins in a loss. Now, what's important to note here is this correction, as we mentioned at the very start of this episode, this correction is actually one of the least severe in 2021. Now, one thing that's also quite interesting, look here on the short-term holder supply and profit. Look at the lows that we had here in July, which is almost zero, right? Almost no coins were in profit. In September, there was slightly more, about 1 million coins. And then note at the lows where we currently are, 1.5 or 2 million coins. Note how we have an uptrend in the lows of total coins that are in profit. What that's saying is that when we look at the short-term holder cohort, which we know statistically are the most likely to respend, even though this correction looks pretty scary, and even though sentiment can be fairly low at this point in time, what we're seeing is that more and more short-term holders at the absolute lows are actually in profit. There's more supply in profit than we've seen in the previous corrections. Now, generally speaking, when coins are in profit, they're less likely to sell because they're not underwater, which is generally painful for investors. They're not seeing price, coming back towards their cost basis and exiting. We've essentially seen that has happened. And we saw some spending, but not everybody is cashing out. And what we're generally seeing is this uptrend where overall there are more profitable coins held by short-term holders, and note the very same for long-term holders. Even at the very lows of this correction, there are more coins in profit for both short and long term than we've seen in the previous corrections. So it's showing that overall, the overall supply dynamics is there are far more profitable coins at the moment in both cohorts, which if we think about that logically, is likely to create less sell side. There's less panicked sellers. Now, what we have to be aware of, that's why we started with derivatives, because that's kind of the big risk that's sitting in the background. What happens if we do get some kind of downside flush? What happens if some macro event flushes the price down further? These are metrics that we can look at to really assess, okay, are we now increasing? Are all those people who were in profit, they've seen a bounce in price recently back to 58, 57,000, they're feeling a little bit calmer. If we do get that downside, are those profitable coins going to fall back underwater, and then we see increased selling? So really, the way I'm looking at things at the moment, that 53,000 level looks relatively key because that's essentially where the short-term holder cost basis is. Long-term holder cost basis is much, much lower. They can generally weather much more downside. We can see here that just the magnitude, right? 76% of the coin supply is held by long-term holders in profit. That's at the very, very lows of this correction. So we're talking about a much, much larger, long-term holders can weather much, much deeper drawdowns, generally speaking, both because their conviction is higher, but also they're more likely to be in higher degrees of profit. But even so, when we look at the lows of these corrections in September and now in November and then back in July as well, we're seeing more and more coins in profit, which is overall relatively healthy. So it's showing this correction is actually quite orderly, it's quite technical. We need to see if we do get some kind of sustained bounce and price appreciation. Certainly, the further the price gets away from 53,000, the more short-term holders are going to feel confident in their positions. And that generally will, again, it's this reflexive loop where you get less sell side, and that can then create positive momentum. But certainly be aware of the risks. Understand where those kind of key levels are that generally we're going to see some kind of psychological reaction from coin holders. And 53,000 really sitting at that level at the moment. So thanks for tuning in. Hopefully you found this one useful. Do give us a rate, review, and subscribe. Let us know how you find these videos in the comments, and I will see you next week. Cheers.